Right. Thank you for joining in. We will start the proceedings of the event in just about a minute as we wait for our guests to join in and for the event to go live on our social channels. Right. I think it's time and we can start. If I can request my fellow panelists to kindly switch on your cameras and join us for the webinar. Thank you. All right. We started the year with an outlook for 2022, where we tried to evaluate what the road ahead looked like, especially coming out from the COVID-19 pandemic and the Omicron variant. And as we took a look at the possibilities, we quickly recognized that the need to be agile was paramount. Before we start this webinar today, it is important to note that wars and the loss of human life it brings are in no way desirable, and the biggest victims are innocent people. We stand with the people of Ukraine in this moment as they stand and fight against the invasion. At the start, not many people expected Russia to mount the full-scale invasion of Ukraine, and the event shocked the world. We have subsequently seen full-scale economic sanctions levied against Russia, and many countries and companies cutting links with Russia. Hello, everyone. Thank you for joining us for today's webinar, where we take a closer look at the evolving geopolitical situation and how to navigate it. Before I introduce our guests, a bit of housekeeping. This webinar is due to last about 60 minutes. If for any reason you get disconnected or logged out, you can use the same link emailed to you to rejoin. We have this available as a recording, and it will be available on our social channels as well. We will have time for question and answers from our audience members, so do definitely type in and submit your question and answers in the Q&A box available on the screen below. Right, with that, kindly allow me to introduce our guest speakers for today. We have with us Mr. Andrew Hardy, who is a long-standing member of Momentum UK's investment team, having been with the company since 2005. Prior to his appointment as Director of Investment Management, he has managed portfolios for over 10 years. During his time at the company, he has played a central role in developing the team's investment philosophy and process while supporting business strategy and development. He is a CFA charter holder and has a BSc in economics from the University of Bath. Also with us today, we have Mr. David Itzkowitz, who is the CEO of Sanlam Global Investment Solutions. Just a second. Investment Solutions, a CEO of Sanlam Global Investment Solutions, a division of Sanlam, a 100-year-old financial institution, and the largest life and investment company in Africa. David has more than 20 years experience in the financial services industry. He was the founding member of a financial startup, which was eventually acquired by a $50 billion global investment firm. Prior to this, David worked for the offshore arm of Old Mutual as regional director, Europe and Canada, where he was responsible for all business development. Before that, he was vice president HSBC Private Bank in New York, where he co-managed a $635 million portfolio of investment, credit, and insurance for high net worth clients. David is a CFA charter holder, has a Bachelor of Science degree from McGill University and an MBA from Ivy Business School at Western University. Also on our panel today is Mr. Tejas Seth, who is the co-founder, manager and equity research lead at NAM India. Tejas has been with the company since Feb 2015 and has 15 years of rich experience in Indian equities research and investment management. He leads research in multiple sectors, covering agri-inputs, chemicals, consumer discretionary, and several other sector agnostic companies. He is an expert in identifying high-growth investment ideas in small and mid-sized companies. Tejas holds an MBA in finance with specialization, with finance as a specialization from Tampere University in Karnataka state. And last but not the least, also with us from Continental is Ms. Neelam Verma, who is the Vice President and Head of Investments for Continental. Neelam is a seasoned professional in both the finance and banking space with over 20 years of experience across investments, banking, private banking, wealth management, corporate and commercial banking, real estate finance, retail banking, and Islamic banking, both in and across India and the UAE. She holds an MBA Finance from New Hampshire University and is an advanced strategic management expert from IIM Ahmedabad. She is also a certified wealth manager from the American Academy of Financial Management and ICWM from CISI UK. Welcome, gentlemen and Neelam, ladies, to the panel, and thank you for being here. My name is Anselm Mendes. I'm the Executive Director Sales at Continental, and it is my pleasure today to be your host and moderator for the webinar. First off, to get us all up to speed, we would like to head over to Neelam, who can bring us and give us an update on the current situation and how it is panning out.
Thank you, Anselm. Good afternoon, everyone.
Good.
It's shocking the way the world is turning out today. While we all are aware that there is a conflict ongoing, we do not know much about the history that has actually led to this. So just a bit of a background. Russia and Ukraine have a long-standing history of violence, and it has normally involved Russian subjugation of Ukraine. Most of Ukraine was a part of the Russian Empire until the Russian Revolution. And it was given a very short few years of independence. And this normally or mostly involved Ukraine fighting a war against the then established Soviet Union. There's a reason that everyone is concerned about a Russian war in Ukraine, simply because all the wars, all the conflicts have been extremely brutal in its nature. The invasion of Ukraine is an event that a lot of people have been following, especially the followers of President Putin. And they have been fearful for this invasion for so many months, maybe years. Let's look at what is happening here. What are the demands that Russia has put in place? Russians want Ukraine to recognize Crimea as a part of Russia and also to recognize the independence of the East. There are also demands that Ukraine change the constitution and ensure that they guarantee Russia that they will not be joining the NATO or the EU. Quite a bit of demands there. The Ukrainian side of the war has been given extensive support by the West, the United States, the European Union, and this has further driven a wedge between Russia and the West. What we've seen is since the war that began on 24th of Feb, over 2 million people, out of that, half of them have been children, have fled Ukraine. And this looks like Europe's worst refugee crisis since the World War II. And it keeps growing by the day. The impact of the invasion is expected to come through various channels, recession possibly in the two countries, damage to trade partners, a potential risk to the energy supply, impact on the energy cost, impact on the real spending power that we were looking at getting unleashed post the impact of the virus, support which comes in from the central banks. But now I think we also are looking at military spending to be boosted by a lot of governments. As a reaction to the entire situation, the West has frozen much of the Central Bank of Russia's assets. And these are estimated to be about $630 billion, which were held in the financial systems in the Western world. Now, that's quite a bit to look at. Apart from that, what we're seeing also is a huge amount of pressure on the Russian financial system owing to the sanctions, which is comparable to a financial crisis. We're expecting very high inflation, which we're going to talk about that in a bit. Squeeze on the spending power of an average Russian, run on the central bank, run on the banks, the Russian ruble. In fact, sharp interest rate hikes were done by the Russian central bank, which proved ineffective. There are also domestic freeze on deposits and a lot of capital controls that can be expected and are already imposed in Russia by the Central Bank of Russia. So that's a little bit of background about what's happening out there. Anselm?
Yep, thank you. I think you've summed it up rather beautifully in terms of bringing all of the pieces together. And before we go to the next question, we have a poll which we'd like to present to our audience, and it should be coming up on your screens right about now. So where do you see the markets ending this year? We've heard a little bit of from Neelam about this, and You've got three options to choose from: higher, low, and remaining around the current level. So let's look at what our audience has to think about that, and we can come back to the response in just about a second. We'll go to Andrew. Andrew, if you'd like to give us a little bit of a sense of, a couple of things. One, how has this conflict, sort of impacted the markets, or we've seen some sense of how the markets have performed. So if you could touch upon both of those points with regard to the performance of the markets from the start of the year, and where do you see this conflict and the impact it is going to have in the markets?
Sure. Hi, everyone. So this year was already off to a choppy start before the conflict really got going. It's a year of transition, really, in terms of fiscal and monetary policy post the recovery from COVID, the pandemic. And then also there were clearly rising geopolitical risks beyond just the Russia-Ukraine conflict and risks around that. But in terms of what that's meant for markets so far, it was a very choppy start to the year with distinct weakness in certain parts of equity markets and more broadly as well. But since the conflict became most likely, really, a few days before it actually started in earnest, we've seen obviously significant weakness in Russian assets, those areas most exposed to the direct consequences of the conflict. So the ruble has pretty much halved in value. The Russian equity market has all but been written off now. And commodity markets have rallied very significantly. So the commodity index is up some 13% or so since the middle of February. And that's been driven by oil in particular, up some 25% or so since then. And also natural gas, which is up about 2/3 since then. But up to a couple of days ago, it had tripled incredibly. So they're the most direct impacts of the conflict and moves in the last couple of weeks. But more broadly, since the conflict started, and indeed prior to then as well, looking at the year overall, we've seen a move out of risk assets generally, so out of equities and credit, and into safe havens, more defensive assets and the like. So just looking at equity markets, since the conflict started, the European equity market has been most affected. It's most vulnerable to the knock-on effects, down some 9% or so. Other markets have proved reasonably resilient relative to that, but still weakening, with other developed markets mostly down 5 or 6% or so. On a year-to-date basis, global equities are down about 11% in US dollar terms, and it's about the same for the emerging market index as well. But within that, there's been huge disparity at the sector level. So the energy sector is up 30% or so on a global basis, whereas tech stocks and the widely referenced New York FANG index is down some 20% or so. So an incredible 50% spread, and a real departure from the benign conditions that we saw in markets over the course of much of last year. And then within credit markets as well, corporate bonds and the like, we've seen a widening of spreads, but we should recognize that it's been minimal. Nothing like what we saw, for example, a couple of years ago when we had the worst of the COVID-related drawdown. And then within defensive assets, gold up some 7% or so since the conflict started. Government bonds rallied for a while, as they always do in risk-off periods, but actually yields have drifted back higher again on expectations that central banks will maintain their path of interest rate hikes, which is what drove the volatility and weakness before the conflict as well. And as those expectations have reasserted themselves, yields have drifted back up. So actually, net government bond yields are in about the same position. So a reasonable amount of weakness, but nothing beyond what you would probably expect for this sort of scenario in terms of the typical response from markets to elevated risks. And no indication at this point, I would say, that there's very serious systemic issues within markets beyond the direct consequences of the conflict.
Thank you. Thank you for that. And it brings me to sort of a question that, I mean, we did refer to this point earlier on with regard to sanctions. And David, if you could pick your mind on, the sanctions that have been imposed on Russia, and of course, there is going to be an impact. Do you see, and if you could give us a little bit of insight on what you see the impact as being, and is there a contagion risk that you are also considering?
Thank you, Anselm, for the question, and thanks for everyone for having me here. With regards to sanctions, I think they are having an effect. And I think, based on the trajectory of sanctions, I think you can look for them to increase. A good example of that is grocery stores in Russia are starting to limit the number of items that Russians can actually buy. So I do think that you will start to see potentially severe rationing taking place, as an example, in Russia because of some of these sanctions that are coming. Look, many of you don't know me, but one of my favorite pastimes is actually reading about history. And if history has taught us anything, is that you never underestimate a Russian's ability to withstand hardship. World War I, World War II, oppression of czars, the Stalin famine in the 1930s. The Russians are a strong and resilient people, and they normally focus on the basics. They need food, which they have wheat. They need energy, which they have oil. So I don't think that those sanctions will really affect, the basics that Russians need. A little bit something that's different about sort of the Russian populace versus other areas globally is that not many Russians own stocks in the Russian stock market, which is very different, as an example, from people living in the US. So the fact that the stock market is closed probably affects a segment of the population, but not the average person in Russia. So will the sanctions have the effect to cause Putin to decide to turn around and leave Ukraine? And I think the answer to that is no. So what is the contagion risk? So NATO, Europe, and the West continue to supply Ukraine with weapons, whether it be Javelin armor or Stinger missiles, ammunition, food, fuel, humanitarian support, and probably the most important is specific real-time intelligence around where the Russians are and potentially how to destroy their tanks and kill their people. So I think there is a willingness that's being shown to try to destroy the Russian economy and to really try to help Ukraine withstand the bombardment that's taking place in Ukraine at the moment. And I think that this can lead to retaliation. And I think that's where the contagion risk really starts. So what does that retaliation look like? If there's one area that Putin has not yet, loosened the dogs of war, it's, I would say, in cyber. So Russia is just below the US with their ability to attack from a cybersecurity standpoint. So where will they target? I do think that as sanctions start to bite more significantly, I do think that you will see Putin let loose those dogs of war with regards to cyber attacks. And I think probably the first area that cyber will attack will be consumer supply chain. The reason why I say that is because there's already a heightened concern in the public around inflation. So if cyber can attack a pipeline, disrupt air travel, disrupt train travel, I think that would be a big win and will continue to drive markets and concern around inflation, driving prices up higher, making people in various jurisdictions and countries more unhappy with the prices rising. So I think that that's probably where you might see the first level of contagion. The only other two areas I would say that probably cyber would target, one would be probably financial institutions, since they are the ones that are holding the assets and really applying the sanctions. I think the good news here is that many big banks have been investing large amounts of money in cybersecurity over the last number of years. And then probably the third area that a cyber would attack would be utilities, water, energy grids, etc. And it's good to remember that in 2017, Russia actually took down the Ukrainian grid. So look to that to potentially be an outcome.
Some pretty heavy stuff there and a lot to think about. There we have the results of the first poll on our screens, and it's tied. 42% of our audience, very, very strange, see it higher, and similar 42% see it continuing at current levels, while 17% of the audience see markets ending lower this year. Some food for thought there. And interestingly, we've got another poll question that sort of links into what we're going to talk about. So we will come to the poll question on screen. There you go. Inflation and its impact. So the question to our audience is, have you seen any impact of rising inflation on your household spending? And the two answers are yes and no. And while we wait for the answers, please do submit your answers to the poll questions, and also do remember that there is a Q&A box on your screen where you can type in the questions that you'd like to ask our panel. So don't forget to enter your question and hit the submit button. Don't forget to submit, because it's important so that we can get the question. All right, we will go to our next question, sort of a follow-up from what we've asked in the poll. And Andrew, we'd like to bring you in. High levels of inflation, concern for investors for some time now, and we've seen that, and we've seen how it's sort of impacted both commodity price and shocks. So how do you see this panning out? How do you see commodity price shocks and higher inflation? And given the context that we've had David express as well with regard to the sanctions and the impact that's been having on Russia as such. So if you can get your views on that.
Yeah, absolutely. Thanks. It's a critical question for investors, because the path of inflation from here will determine the path of interest rates around the world, and that has knock-on consequences for the returns of all asset classes. And it's a real conundrum for central banks as to what to do at this point. We've come into this period with inflation in the US as of yesterday's latest print, 7.9% CPI. It's incredibly high, and we know that was driven by the supply shock created by the pandemic, and then the following demand surge contributing to that. But the expectation was that it was temporary, and that later in this year inflation would subside, still being above target, but that it would start to come back, and that inflation and central banks could bring it under control. But this conflict is now causing a massive push, another additional supply shock, and further inflation pressure coming from energy and commodities more broadly. So that's going to push out any normalization in the inflation rate, and gives central banks this real challenge of do they maintain the path of expected interest rate hikes, or even attack it more earnestly. In the US, there's already 6 interest rate hikes priced in for this year, and that's been maintained throughout this period, really. Do they maintain that, recognizing that monetary policy is not going to do much or anything to contain the issue that we have with commodity prices from a supply shock, and also recognizing the ultimately deflationary consequences that this conflict could have on the rest of the world through higher inflation, higher energy prices, and potentially a knock on confidence as well, which, all else equal, given a slowdown in growth that might create, central banks would normally loosen policy. I mean, just to put the scale of the problem across, Russia produces about 1/8 of the world's crude oil and about 1/6 of the gas, as well as a wide range of industrial and precious metals, which are key in supply chains. And then also between Russia and Ukraine, they're producing about 30% of the world's exports of wheat and barley. So we're seeing very, very broad-based inflation pressure at this point, and looking at some of those commodity price moves that I mentioned earlier. And if that is sustained, then that's really making a significant problem for central banks. In terms of the long-term consequences, I think the risk is the longer inflation stays this elevated, the more persistent it will likely be, because there's a greater risk that inflation expectations are built into wage negotiations. And once it's built in there, that's much stickier inflation, much more so than your headline, more volatile inflation measures. And essentially, that inflation spiral can begin. And once the genie's out of the bottle, it's hard to get back in, ultimately. So that's the real risk here. And we think ultimately there's a reasonable chance that central banks can't increase rates as much as they would like to at this point. And ultimately it's getting harder and harder to bring under control. So a serious factor for investors to consider at this point. And one final comment on that would just be that Looking out further than 5 years or so, so one closely watched measure in markets relating to the US is the five-year inflation rate. So that's looking at what is inflation expected to be in years 5 to 10 from here. So markets are implying a high level of inflation for the next 5 years, but thereafter, expectations are actually still fairly well anchored. It's about 2.7% in the US at the moment. It's drifted up, but that's not indicating serious cause for long-term concern. But the longer this goes on, the higher that's likely to go.
Yep. Thank you for that. A bit of the Pandora's box situation. We've got the results of our second poll question. They're up there on screen. The impact of inflation, have you seen impact? 89% of our audience agree that their monthly expenditure has increased. So that impact of inflation being felt quite strongly with the audience here in the UAE and the MENA region. So yeah, thank you for that. And I think part of that, of course, is impacted by the rising sort of oil prices, if you will. And that's where I'd like to bring in Tejas. For countries like India that are net importers, how do you see the impact of oil prices and the current scenario?
Yeah, thanks, Anjan. Good evening, everyone.
Good evening.
So on the specific to India, I mean, obviously India is a net importer of oil and gas. I mean, 75% of our oil is imported. Nearly 50% of the gas is imported from Middle East, and obviously percolates a big time into the consumption pricing of these products. The other area also for India, weak area is the fertilizers. I mean, we are a big importer of fertilizers, and Russia and Ukraine being one of the largest manufacturer of fertilizers at the global level. The prices of some of the base fertilizers have gone through the roof, and it is the trajectory is only upward. So obviously the current account balance of the country will be under severe pressure, and that will obviously lead to the pressure on the currency side. The only good part here is India has a good stock of wheat. So the inventory of wheat, which was lying in the warehouse and which was becoming a negative for the government towards hoarding the wheat, has actually worked well for them now, considering that the wheat prices at the global level too has gone through the roof. So probably some respite will be there on the current account balance, where I think India will be exporting a huge amount of wheat this year. Second is the foreign exchange reserves. I mean, India today is probably at the highest level of forex reserves, which it has seen. And that kind of helps them to maintain the currency. So if the currency depreciates, and if it adds more to the import bill, right? So I think the central bank has been intervening. It's not letting the INR depreciate to the extent the other emerging market is seeing the depreciation. And I think that's where kind of the import bill is getting hold on. So if we put the maths together, I think $100 billion worth of impact is going to be seen if the prices at the current level persist for the next 12 months. I hope it doesn't do that. And that $100 billion, obviously some of that will be passed on to the consumers. Some of that will be shared by the between the government and the oil PSUs. Will the inflation get in the higher levels? Obviously, it will get, because a good share of this inflation is also imported, right? India is also importing a lot of capital goods for the manufacturing sector. Right. So that also will have its impact. Ultimately, it is the right balance the government will have to make between the current account deficit, between the reserves, and between the currency. And since the whole world is entering to 2020 with the high debt to GDP ratio, I think managing the fiscal deficit at the current level will be a task. So my wishes actually go to all the central bankers at the global level to manage this kind of balance between these three areas of the economy.
Quite a task on hand that they've got. I'm just going to sort of dive a little more deeper into this. I mean, if you, I mean, from where we started off with regard to energy, how do you see? I mean, do you see a path towards energy independence?
At the global level, I mean, the worst region which is currently hit is Europe. I mean, they more than realize the concentration risk which they are running with Russia, being 40% of the gas, 45% of the coal, and 27% of the oil getting imported from Russia, and which politically is not an ally per se. So obviously the European region would obviously think on that path, but it's easy said and then done, right? I mean, if you see last 10 years, moving towards renewables it's not been an easy task. I mean, 10% of Europe's energy was renewable, and after 10 years also it's still today at 20%. And the projection for next 10 years is 30%. So obviously they will have to move towards that share at a faster rate. I think the world will now look at three side of strategies towards independence, energy independence. One, I think every country will increase the storage capacity, and hence they'll try to have as many days of energy consumption inland rather than getting imported. So that is the easiest path to independence as of now. The second would be a little bit of medium term to long term, where every country will focus that is there any other energy source which they would want in terms of diversifying from the country from whom they are sourcing, and also on the renewable side or the green energy side. So all that path will be there. For the near term, I think the ESG narrative will take a backseat. Conventional fossil fuels will be in demand, is where the countries will try to get the independence. And I think that's the path in the near term. And a lot of investment will be going towards storage of energy and towards new energy like hydrogen green, and towards the EV side of the market.
Yep. Thank you for that. I mean, I think you've given us a good sort of tempered the exuberance in the sense that, I mean, many of us probably considered, especially with many of the initiatives on the ESG side, etc., that energy independence could be a lot sooner. But yes, I think we need to be able to ride through the cycles. Neelam, sort of bringing you in and looking at the MENA and GCC. The regional economies, and oil, of course, is a very important part of the story in the GCC and the MENA region. What do you see the impact of oil prices here?
Anselm, the pandemic actually had led to a sharp decline in oil prices over the last couple of years. And we just started seeing that build up in the oil price last year towards the middle of the year. This meant that the revenues would be higher for oil producing and exporting nations. The oil surge due to the current crisis has pushed the prices above the break-even level for most of the Middle East producers. And this means that there are huge budget surpluses that can be expected even for the weakest of economies if the prices continue to remain high. I was reading a lot of articles wherein we were looking at price projections at even $185 to begin with. Russia's invasion has actually led to the prices currently in the range of $105, $110 a barrel for the first ever time since 2014. Now, this basically is extending a lot of gains which were propelled by economies around the world, especially after reopening which was due to the coronavirus lockdown. This fighting in Ukraine means that OPEC members like Saudi Arabia, UAE, etc., are even set for a bigger windfall. And there is a possibility that smaller countries like Bahrain, for instance, which we do not consider as a major exporter, also to start looking at a record in terms of their budgets since a long time. This was also boost a lot of confidence, replenish a lot of balance sheets, and support the economic recovery of Gulf countries. If you've seen that the coronavirus impact had actually led to a lot of reforms in the Gulf countries, this oil price soaring would actually fill in the coffers further, and the Middle East countries might also, due to this price rise, see increase in commodity price rise, which could also trigger inflation here. So investors would look at, for possibly a safe haven in the Gulf dollar pegs, which basically should also bring in the risk which a lot of these countries come in with. So this is what is my take on Middle East. I think UAE will try and convince the OPEC Plus to try and increase the oil output further, which I think was in the papers yesterday that yes,
Correct.
they managed to convince. So that should ease off the prices on the oil a little more.
Sure. Sure. Thank you for that. I think you've summed it up beautifully. And that brings us to our next poll question, which should be coming up on the screen just about now. There we go. Given what you heard today, given the background, the geopolitical conflict, what asset classes do you think will perform the best over the next, let's say, short time, 1 to 3 months? We've got cash, global equities, agricultural commodities, energy stocks, and gold for you to take a pick from. We'll go to Andrew for our next question. So, it has been touched upon. I think David did mention, that as a people, we are quite resilient. And Andrew, I'm going to sort of pick your thoughts on, historically, we've seen many geopolitical sort of market-driven events, world wars, the world wars, 9/11, Afghanistan, the Arab Spring. When you look at it from a historical perspective, what do you see as the long-term impact on financial markets?
Yeah, sure. It's the right way to look at it and use history as a guide as much as possible. And the simple answer is, if you look back through history at the countless geopolitical risk events, since the Second World War or so, typically you get a risk-off period in markets. It leads to an increase in volatility. Equity markets fall. You have a drawdown period. But the average experience is fairly muted, actually, and fairly short-lived. So a simple average would tell you a couple of weeks drawdown and then usually a couple of weeks recovery. However, there's often a lot of variation beneath that. The average drawdown might be 7 or 8% or something like that, but in some cases they've been much more prolonged. Of course, more so around the bigger, more significant, wider reaching conflicts. So it's useful to look at that and should give some confidence, really, that ultimately these sort of events can prove to be a buying opportunity eventually. Are we at that point now? It's hard to judge. I think that the key thing we need to recognize in this current situation is that geopolitics are very, very difficult to predict. People weren't expecting Russia to invade Ukraine as little as a month ago or so, despite them encircling the country. And the path from here is very, very uncertain. So we need to recognize that. The historical scenario that many market participants are referencing now, rightly so, I think, is actually looking back to the 70s, and in particular the Arab-Israel conflict in the earlier part of that decade, because that has most parallels with now, particularly because it led to pretty much the largest ever oil price shock. And occurred at a time when inflation was already running high. That was a very, very, very bad period for markets, and that lasted for several years. But there are a lot of differences with that situation now. The world is less dependent on oil now than it was then. The oil price was more depressed, coming from a more depressed level today than it was back then. In that case, back in the 70s, the oil price remained exceptionally high for several years. We don't know yet how long this is going to last and how long the oil price remain elevated. And also rates are much lower now and expected to stay that way, versus in the 70s we saw a massive hiking cycle, which may yet come to pass here, but I don't think it's ever going to be on that same sort of level. However, bottom line, after a few years, which is a long time to wait, that proved to be one of the best long-term buying opportunities in markets ever. On in terms of the next few years and in the next 10, 20 years or so. So a lot of cause for uncertainty and nervousness, but the lesson from history is that usually the best course of action is to stay invested and to actually invest more at times, maybe over a gradual time period, and use it as a long-term buying opportunity.
Yeah, I think very well put, and a quote that keeps coming up in my mind with regard to what you spoke about is something by Warren Buffett, who said, be fearful when others are greedy and greedy when others are fearful. So a good thing to sort of think about from a longer term perspective. We've got our poll answers on screen, and before we get to the answers and before I read them, I'd just like to remind our audience members that there is a question and answer box below where you are able to sort of feed in your questions and submit it and send it across to our panelists to answer. We will be getting to those question and answers shortly. Please do submit your questions. With regard to our poll question, in the light of the geopolitical conflict, we see that about 36% are looking at gold as the best performing asset over the next 3 months, or the next 1 to 3 months, followed by energy stocks and global equities, with cash and commodities, agricultural commodities, coming in at 14 and 7%. All right. That certainly was an interesting response to the poll question. David, we're going to go to you with regard to your sense of the investors and how worried they would do you see them to be over the conflict in Ukraine. Also, I mean, are they overblown? How do you think this is going to end? If you can give us and share your perspective with us on that.
Sure. First of all, I think Andrew and Neelan covered well sort of the economic piece of how worried investors are. So I think that was well covered. I think one area that you tend to see a lot in media is really around if this increases, and really the use of, let's say, nuclear weapons or a tactical nuke. So there are two types of nuclear weapons. One is a full-blown, what you see in movies, that type of nuclear weapon. And then a tactical nuke, which is a smaller device, which obviously is just confined to a small area. So I think, how worried should investors be about that? Because that would be a significant escalation and would mean markets would take a significant dive. So first, I think we need to understand Putin from a mental state. I don't think that Putin is crazy. I don't think that Putin is irrational. I think he's angry, potentially bitter, and he's made a big, probably public mistake where he probably estimated that Ukraine would be captured relatively quickly. And obviously it's now been drawn out significantly. And I think that he's very tied to the outcome of this war. So the use of a tactical nuke even is probably highly unlikely. First of all, Putin has children. He cares about Russia significantly. And the truth is, when you use these types of weapons, Russia's right next door. The wind will carry fallout potentially his way. So should investors be worried about that? I don't think so. Where I do think that scenario or probability starts to increase is if NATO has a significant involvement and escalation. Then I do think this becomes a little bit more of a wild card. So how does this end? Because no one knows. I think that there's still a number of cards to be played. As an example, is President Zelensky captured? Is he killed? Do the Russians start to get their act together a little bit more with regards to logistics? So when I think about these things, I tend to think in probabilities. So I think that there is a high probability, probably 50% or more, that this conflict gets sorted very similar to how the Balkans were sorted in the 1990s, which basically means that about 30% of Ukraine, which is Russian ethnic, Russian speaking, really under the extreme influence of Russia, becomes part of Russia. And that is really from Crimea along the Black Sea coast to Mariupol up to Donetsk. That area probably becomes part of Russia. Then the rest of Ukraine, assuming that President Zelensky is able to hold off the Russian army, will probably continue to remain under a Zelensky or more democratic environment. If that happens, there will probably have to be some sort of pledge where Ukraine does not apply to become a NATO or a country of part of NATO. And by the way, this is not a scenario that anyone will like, right? Especially Putin. He will feel that he will fall short. The US will hate it because they will have given something to Russia. The Ukrainians will hate it because they will have lost part of their country. But maybe that's why this is the most likely scenario, because it ends up being a compromise that no one really likes. So I would give that probably a 50% probability. And then a 30 to 35% probability is that Russia do continue to throw so much weaponry, so much artillery at Ukraine that they do take over Ukraine, but probably a destroyed Ukraine. So those are the two largest probabilities. And then you have probably two much smaller up, which is maybe a 10% chance that Zelensky does pull out a military win here with the significant assistance from NATO and the US with the weapons that he's getting. And then the very, very small, but what I would call maybe a hopeful outlier, you always need one of those small outliers, is that someone in Putin's circle, maybe oligarchs, et cetera, that don't want to be international pariahs, that want to get their yachts back and have their kids in school. Someone in Putin's circle tries to take Putin out. But I think that, there's a saying, if you're going to aim for the king, make sure you kill the king. And I think that there are many people that will be very frightened about trying to take Putin out because, he has special intelligence troops around him all the time.
Sure.
And that will be very challenging.
Yep. I think a lot to think about there, certainly. I mean, probabilities, like you said, probably is the best way to sort of go about it and consider and think about it. We've got one sort of last question to ponder on, and I'm going to get each of your views on it. And if we can start with you, Tejas, near-term concerns for investors, what should they be aware of, and in your views, how can we? What's the message that we can give to clients with regard to positioning their portfolios, the best way to sort of protect and grow their wealth given the kind of volatility we are seeing?
I think barring the Ukraine-Russia crisis, I think the biggest risk is the inflation. We enter 2022, despite of the war, we enter 2022 with a very, very high inflation environment. China, to my mind, holds the cards here because they control a good share of supply chain. They had shut down a good share of that supply chain because of the Winter Olympics. And with Winter Olympics getting done, the current MPC meeting states that the growth will be at 5.5%, which was, I think, much above what economists were actually expecting. Economists were at around 4 to 4.5%. So that's a positive surprise here. China today, unlike in other crises, is nearly 20% of the global economy. So if they go towards quantitative easing, because most of the Western world would be actually contracting their balance sheet. So China is the only one which can go towards expanding the balance sheet and creating a larger demand at the global level, at the same time easing the supply issues. So at the both side, on the growth and the inflation, I think China is the key player for 2022. And if any variable one needs to track is the inflation. On the multi-decade inflation and the kind of hockey stance which most of the central banks will take, the growth will be under pressure, not only on the consumption side, but even on the public spending side, because a lot of countries, as I said, has entered 2022 with a very high debt to GDP ratio. So the public spending room for the balance sheet of these countries is very limited. And if the interest rate cycle goes on an uptick, I think the interest costs have a huge burden on their balance sheet.
Sure.
So inflation is the only variable actually one needs to.
All right. The message very clear from Tejas there. Andrew, we'll go over to you. From the perspective of investors, what should they be concerned about? And how would you advise, or how would you suggest that they best position their portfolios given volatility and obviously the desire to grow?
Yeah, thanks. The big two risks, I'd agree. One is around the inflation side of things. For the first time in decades, I think we've got a higher inflation environment potentially here to stay, and that's a massive paradigm shift for markets. And then the other side of things is the conflict as well, which as much as it might be short-lived, potentially is ushering in a very different era from here. If you think back to the quote attributed to Lenin in terms of there are years when nothing happens and there are weeks when decades happen. It does feel like we might be in that sort of period at this point, and uncertainty is exceptionally high. What should investors do about that, or what should they be particularly wary of? I'd say there's two things in particular around one theme. Don't necessarily extrapolate what's happened over the last 5, 10, 15 years in markets. I think the environment going forward could result in very different patterns of asset class returns. And what was dependable in the past may not be dependable in the future. In particular, bonds, government bonds and the like, ultra low yields at this point when inflation is surging. There's every chance that bonds provide very little protection going forward from here, and actually become a big source of risk in portfolios. So the typical 60-40 balanced portfolio, I think, is potentially very risky if you have 40% of your money in typical high-grade government bonds and the like. And then also a byproduct of that low rates environment has been the strong performance of tech stocks, the FANGs and the like for many, many years. And markets have become very concentrated. If you invest in a S&P 500 US equity tracker, you've got a huge concentration into those winners from the last decade or so. But I think the next 10 years or so, or indeed the short term, could be much different for those businesses. And we'd encourage a much more diversified approach from here. But ultimately, uncertainty is high, but also recognize that as much as we highlight those two risks, some of the biggest risks, some of the things that do the most damage to portfolios are the unknown unknowns, the things that we don't know yet around the corner. I think the pandemic was a fantastic example of that, really. No one saw that coming, and that shakes markets to the core. The best way to manage the current risks that we can see and for those unknown unknowns is really to, I think, twofold: have a long-term approach and have a very well diversified approach as well. The old adage of, it's time in the markets rather than attempting to time the markets that leads to the best returns overall. And in particular at the moment within portfolios, we've been doing it for some time, and we'll continue to do so. And I think it's a good strategy. You need to emphasize asset classes that give you better than average inflation protection. So in particular, real assets, areas like property, infrastructure, and the like. They've performed well so far this year, but I think the scene is set for them to continue to deliver, and investors should make sure they have enough allocations to those for the long term, I would say.
Sure. Thank you for that, Andrew. David?
I thought Tejas and Andrew answered this question well. If I would just add one or 2 points, I do think that investors should expect continued volatility in the markets, particularly over the short term, and depending on how things play out. If there's one thing that maybe we haven't touched on, I would say is that probably this is a good time for investors to shore up a little bit make sure they have ample liquidity with easy access to live their lives. And I would say probably for a period of 12 to 18 months. Why do I say that? It's because people forget that during, as an example, periods in World War I, the stock market was shut in Europe, in US for long periods of time. So you want to make sure that you do have some liquidity on the side that's sitting there that's easily accessible should that scenario start to take place again. And similar to what was mentioned, maybe just reorient your style bias a little bit. I think, as Andrew mentioned, there's been a heavy focus on growth over the last number of years. Maybe this is a good time to look at value-oriented stocks. Things that are inflation linked, I think, will be very, very strong proponents. And you basically do want to stay away from things that have extreme convexity risk, meaning that if they're affected by interest rates, like in fixed income, you want to try to avoid probably those areas.
Thank you for that. Thank you, David. And Neelam?
Well, I think the fellow panelists have covered it all. I would just say that we continue to encourage our clients to stay invested in the recommended asset allocation. As everyone said, diversification remains the key. It's important to stay invested in a combination of safe assets and some risk. We do know that last year everyone was very risk on. This year began risk off. But yeah, it's time to sit back and understand what do we have in our portfolio. We at Continental continue to stay overweight in equities, both US as well as the local equities. We still feel that there's a lot of value that we can add. we do expect to see some downside. And as everyone said, we will look at markets to continue to be volatile. And we can expect some sharp swings as we've seen in the last fortnight or so. I think it's important for clients to understand that it's good to stay on course. The long-term strategy should not change because of such events. Recalibration can be done in case there's a need. As David said, whatever cash we have should be deployed if required, as and when the markets do present an opportunity. The idea is stay with the fundamentals, stay with good growth stocks as you've been, stay invested in some good collectives, and look at allocating a part of your asset allocation towards those safe haven assets, which we've been recommending as a part of the portfolio, whether it has been gold or energy. So my advice is stay invested in the recommended asset allocation for the time being.
Excellent. Thank you. I think every one of you has brought in, some excellent points that our audience can think about and should think about. And I'd just like to add one aspect that, sometimes it can be tricky to obviously go through these times. And I am going to put in a shameless plug here for our advisors and suggest that do work with a professional, whomever it is, whether it is from Continental, whether it is from somewhere else. I think they bring a good value to being able to navigate these times, especially because when it's our own money, it can be a bit emotional. And sometimes that can sort of distort the ability that we have to be able to make the right decision. So do work with a professional. It can help you in these times. A good financial professional will be able to guide you and take you through, remind you of the reasons, the goals, as well as the risk appetites and the reasons for putting in the money and the investments that you've made. Perfect. We've got one last poll question, and that's going to pop up on screen, and we're going to go to the Q&A from the audience. We've tried to, I think, provide you with a viewpoint, both from a sense of opportunity as well as what is going on and how that sort of pans out. And what we'd like to hear from you is, are you worried about the impact of the Russia-Ukraine conflict on your portfolio? So we'll go to our first audience question in the meantime, while the poll responses are being compiled. And that should be coming up on screen just about now. Well, and I'm going to read the question while the team puts it out. What do you think is the worst case scenario that investors should be prepared for? Okay. And I'd like to, anyone from the panel would like to take this question? Or do you want me to nominate somebody? All right. Andrew, would you like to take that question?
Sure. I mean, the very, very, very worst case scenario is a nuclear apocalypse, but you can't position your portfolio for that, and nor should you. And you've got to be realistic about probabilities, and I think that's very unlikely. At this point, I think the likely worst case scenario for the medium term is a stagflationary environment. So high inflation, sticky, and central banks raising interest rates significantly into a slowing growth or recessionary environment. That's very negative for asset class returns, largely across the board. Hence my comment about emphasizing inflation-protected assets in portfolios, real assets, gold, inflation-linked bonds, whatever it may be. A healthy allocation to those, I think, is prudent at this stage. Even if we avoid stagflation, I think they will do better from here.
Excellent. Thank you, Andrew. And we will go to the results. There we have them on screen. Wow, we've got a very, very good set of sensible investors, I think, and I'm really happy to see those results. No, I see this as an opportunity to add to my portfolio, with 52% of the audience giving that response. So very, very heartening to see. We've got our next audience question coming up on screen, and that is, what will be the impact on the travel and airline sector? Okay, an interesting question there again. David, would you like to take a shot at that?
Sure, and I will say I'm not an expert in the travel or airline sector to start.
Sure.
I do see really, I would have to actually have to say that Corona had a much bigger effect on the travel and airline industry, I think, than this particular conflict is having.
Sure.
Obviously, if it escalates, you're not going to be traveling anywhere near that region, and probably people are not traveling to that region now anyways. But I do think that obviously Russian travel industry has been greatly impacted already by the sanctions. You know, planes cannot fly into Europe and fly into other areas. But I think for most you know, people living around the world, I don't think there's going to be much impact in this particular industry.
Thank you for that. And I think we've just about time for our one last question. And if the team can put that up on screen, then we will be able to. Yep, there you go. Which sectors are likely to be the most positively and negatively affected as the war continues? Oh, okay. Tejas and Neelam, if you'd like to each sort of add to and address this question. If we can go with Tejas first and Neelam after Tejas.
Yeah, so positively, obviously, it is going to be the metal sector, oil and gas. Obviously, the countries which are producing that will see a huge uptick. Countries who are net exporter, or even companies who are net exporter and can make a good buck out of these inflation at the global level, will benefit big time. Negative will be obviously companies who are consuming this material, right? So anybody who is consuming the polymers, plastics, and which are not able to pass on to their customers, which will be big time impacted. So predominantly, I think the safe side to be is obviously the staples and the healthcare sector. Even the past stagflation and recessionary trends show that even during the wars, the healthcare sector and the staples are the outperforming sectors. And the one which take a beating is technology, high multiple driven sectors, where there's a lot of capital which goes out of those sectors in terms of capital flows. Financials is another sector which get big time impacted because they are mainly economic driven sector, and hence that sector also takes a huge beating. So, and lastly is the auto sector. I mean, auto being the largest consumer of metal and precious metal, as well as the oil pricing increasing lowers the affordability in a lot of countries towards consuming the automobile. So I think automobile sector also takes a huge beating. So that is also a sector one needs to avoid.
Thank you, Tejas. Neelam?
In my opinion, I think we should look at positive sectors like the consumers. They do not get impacted. War or no war, people will continue to consume. So we go back to the fundamentals. We go back to the original companies, Nestle's, the Colgates, you know, the Cadbury's. They continue to grow, and we'll look at those. We look at allocations in those. I think oil or energy related sector, we've been talking about this over the last 1 year, and plants have seen good returns there. So they'll continue to be in the positive space. Mining is another industry. Commodity prices have gone up. We're looking at commodity sector as the positive. On a negative side, I think I echo what they just said. We would not be looking at auto sector. We did not look at. We looked at only electric vehicles last year. We've all been talking about the auto segment moving into the electric, domain. So that was one sector that we saw, but that is also getting impacted. One more sector that I see positive is the cybersecurity sector, the fintech sector again. These two sectors, because of the kind of condition that people have seen, and with slight impact of the virus still prevailing, cybersecurity and fintech is another positive sector that one can look out for.
Perfect. Thank you so much, Neelam. And a big thank you to our partners, Momentum, Sanlam, Nippon Asset Management, and of course to our panelists who've taken the time to join us today. Andrew, Tejas, David, for not just joining us and sharing their knowledge and experience and their thoughts with us and spending time with us. Also, a big thank you to Neelam, and to most of all, to you, our attendees. I'm not going to thank you for your time, but no, I will say a huge thank you for your attention. As you exit, we have a short feedback form for you. Please do take a moment to fill it in. It helps us in not just analyzing what we're doing right, but also gives us suggestions of what we should do in the future so that we can serve you better. Have a wonderful evening, everyone. I hope to see you at many, many more of our webinars. Thank you.